Something happened to silver in 2026 that nobody saw coming. And I don't mean the war itself. Everybody saw the war coming. What nobody predicted, not the banks, not the analysts, not even the most seasoned precious metals investors, was what the war would actually do to silver. Because it didn't do what history told us it would. And that contradiction, that massive, glaring reversal of everything we thought we knew about silver as a safe haven asset, is exactly what we need to talk about today. Because buried inside this story is one of the most important setups in silver's modern history. And if you understand what's actually happening right now, you'll see what most people are completely missing. If you're new here, welcome to Gold and Silver Intelligence. Hit that subscribe button right now because what we cover on this channel is exactly what you need to navigate moments like this one. And this moment is unlike anything we've seen before. Let's start with a number. $121.78. That was silver's all-time high, reached on January 29th, 2026. Think about that. Silver, the same metal you could buy for under $20 just a few years ago, had surged to a level that shocked even the most bullish forecasters. The run-up was extraordinary. Silver had gained roughly 145% throughout 2025 alone, driven by relentless industrial demand from solar panels, electric vehicles, and electronics, combined with a wave of investment buying that pushed the metal to heights nobody had seen in modern market history. And then the war started. On February 28, 2026, US and Israeli forces launched a joint military operation on Iranian territory. The Middle East, already a region sitting on a powder keg, exploded into open conflict. And here's where the story gets strange. Here's where everything we thought we knew gets turned upside down. Because when the bombs started falling, silver didn't do what silver is supposed to do. It didn't rally. It didn't surge on safe haven demand. It didn't behave like the monetary metal it's supposed to be in a crisis. Instead, it collapsed. Now stay with me here, because this is not just a simple story about a price drop. This is a story about a once-in-a-generation shift in the forces controlling silver's price. And once you understand this shift, you'll understand not just what happened, but what comes next. And what comes next is what this entire video is building toward. Within days of the conflict beginning, silver was already cracking lower. By March 23rd, silver had fallen to $61 per ounce. That is a nearly 50% collapse from its all-time high set just weeks earlier. 50%. In a matter of weeks. On the same metal that experts were calling the investment opportunity of the decade. The same metal underpinning the entire green energy revolution. How does that happen? How does a global war cause one of the most strategically critical commodities on Earth to lose half its value? That's the question. And the answer is far more important than the price move itself. Here's where things get interesting. To understand what happened to silver, you have to understand the two completely different versions of silver that exist in today's market. There is silver, the monetary metal, the safe haven asset, the store of value, the thing people buy when the world is falling apart. And then there is silver, the industrial commodity, the critical input for solar panels, EV batteries, AI data centers, electronics, and advanced manufacturing. These two identities usually work in silver's favor. Usually, rising industrial demand and rising safe haven demand pull the price higher together. But in a very specific set of conditions that this war created, those two forces turn against each other. And that's exactly what we saw. When the conflict escalated and oil infrastructure in the region came under threat, energy prices spiked hard and fast. Brent crude surged over 12% in a single day following escalation announcements in early April. That energy shock immediately ignited inflation expectations across global markets. And here's the chain reaction that matters. Rising inflation expectations pushed central banks toward hawkish policy. The Federal Reserve, which had been expected to cut rates twice in 2026 before the war, suddenly shifted. Markets stopped pricing in rate cuts entirely. Then they started pricing in the possibility of rate hikes. And when rate expectations go hawkish, silver, which pays no yield, no dividend, no interest, becomes less attractive to institutional money overnight. At the same time, the industrial demand story for silver hit a wall. Manufacturing PMI indicators across major economies declined sharply as companies froze capital expenditures and stopped accumulating raw material inventory. The same solar panel manufacturers and EV producers who had been driving silver demand higher through all of 2025 went quiet. They stopped buying. They pulled back. Because when you're looking at a war-driven economic slowdown, you don't pile into raw materials, you conserve cash and wait. And then, this is a detail most people completely missed, institutional investors who had made enormous profits riding silver's 145% surge in 2025 saw the war's initial spike as their exit. The brief safe haven pop in silver's price during the first hours of the conflict gave the big money the liquidity they needed to unload their positions. What looked like safe haven buying from the outside was actually exit liquidity for institutions booking profits. The result was a cascade of selling that overwhelmed any genuine safe haven demand that entered the market. But that is only part of the story, because there's something else happening in the background, something that the mainstream financial media has barely touched. And this is where the real opportunity begins to take shape. Let's talk about what the war did not change. The war did not change silver's structural supply deficit. The Silver Institute's own projections show a 46.3 million ounce deficit expected in 2026, 15% larger than last year's already substantial shortfall. Since 2021, above-ground silver stocks have declined by a total of 762 million ounces. That's not a rounding error. That's a 5-year trend of sustained depletion. And mine supply? Mine supply is projected to grow by just 0.3% in 2026. Not 3%, 0.3%. The Earth is simply not producing enough silver to meet the demand that already exists, and that demand is only growing. Think about what that means. The green energy transition is not pausing for the Iran war. Solar panel deployment globally is not slowing down because of Middle Eastern tensions. AI data centers, which require silver for their advanced semiconductors and connectors, are being built at a pace that was unimaginable just 5 years ago. Every electric vehicle produced requires silver in its electronics and battery management systems. These are structural, long-term demand drivers that do not respond to geopolitical headlines. They respond to the global economy's fundamental direction of travel, and that direction hasn't changed. Now here's the detail most people miss. When silver crashed from its January highs towards $60, something fascinating happened in the physical market. Industrial buyers, the solar and EV manufacturers who had stepped back when silver was at $120, started coming back. Reports from May 2026 indicate that physical silver buyers returned in force around the $80 level. These are real buyers, not speculators, not paper traders, real manufacturers who need the metal to build real products. And they came back because at those prices, the economics of securing physical silver supply made sense again. This is what the paper market misses. While futures traders are selling silver because they're worried about rate hikes and a stronger dollar, the people who actually need silver to keep their factories running are loading up. But something happened next that I want you to really pay attention to, because this is where the setup gets bigger, much bigger than most investors realize. Around the same time industrial buyers were returning, diplomatic channels started moving. In May 2026, reports emerged that the White House was nearing a formal agreement with Iran. A one-page memorandum of understanding transmitted through Pakistani mediators that would formally end the conflict and allow the gradual reopening of the Strait of Hormuz. Tehran confirmed it was reviewing the proposal, and silver, which had been crushed primarily because of the war's impact on inflation expectations and rate policy, jumped 6% in a single day on that news. 6% in one day. That reaction told you something important. It told you the market understands exactly what a de-escalation means for silver's price. The moment the war's inflationary pressure begins to ease, the moment rate hike fears start fading, silver's industrial demand story comes roaring back with everything it had before the conflict started, plus months of pent-up demand from buyers who have been sitting on the sidelines waiting for a better entry point. But as of right now, in June of 2026, silver is trading around $63 to $66 per ounce. That ceasefire is still conditional. The conflict is still ongoing. Inflation data for April came in above expectations. The Federal Reserve under Kevin Warsh has pushed back any expectations of rate cuts for the foreseeable future, and silver remains down more than 40% from its January all-time high. Here's what that means for anyone paying attention. You have an asset that surged 145% in 2025 on fundamentals that haven't changed. You have an asset sitting on a confirmed multi-year structural supply deficit that is actually getting larger each year. You have an asset that serves as the backbone of the green energy transition, AI infrastructure, and advanced electronics manufacturing, all sectors that continue to grow regardless of Middle Eastern geopolitics. And right now, that asset is on sale at a 40+% discount from its recent all-time high because a war created a temporary set of macro conditions, higher energy prices, higher rate expectations, stronger dollar, that crushed its price even as its long-term demand story remained completely intact. That is not a disaster. That is a setup. Now, I want to be very clear about something. This is not financial advice. What we do here at Gold and Silver Intelligence is analyze the forces moving precious metals markets and present the evidence as clearly as we can. What you do with that information is your decision. But let's look at what the forecasters are actually saying. Multiple major institutional analysts have maintained long-term price targets for silver well above current levels. JP Morgan Research projects an average silver price of $81 per ounce for 2026, with a potential high of $85 in the fourth quarter. Gold Silver's lead analyst expects silver to trade above $100 as supply deficits deepen. Some of the more aggressive forecasts from analysts tracking the gold-silver ratio are targeting $150 per ounce or higher, based on the mathematical relationship between gold and silver prices if the ratio compresses toward historical norms. Gold itself has been held up by relentless central bank buying. China's People's Bank of China has maintained its gold purchases for more than 17 consecutive months, and most major institutional price targets for gold are clustered between $5,500 and $6,000 per ounce by year-end. If gold reaches those targets, and the gold-to-silver ratio compresses even modestly toward historical averages, the math for silver's upside becomes extraordinary. But here's the most important question, and this is what I want you to think about after this video ends. The Iran war didn't create silver's supply deficit. The Iran war didn't slow the solar industry's expansion. The Iran war didn't reduce the amount of silver required to build an EV or power an AI data center. What the Iran war did, and this is critical, was create a temporary macro environment that suppressed silver's price in the paper market, while the underlying physical demand story remained completely intact. In fact, 5 years of above-ground stock depletion means the physical supply situation has actually gotten tighter during the period when the paper price was falling. At some point, those two realities have to converge, and when they do, the move in silver will be one for the history books. What does the resolution of this conflict look like for silver? Think through the chain carefully. A ceasefire or formal peace agreement removes the energy price spike that has driven inflation expectations higher. Lower energy prices mean central banks can ease off their hawkish stance. The Federal Reserve returns to a path of rate cuts, or at minimum removes the threat of hikes. A lower rate environment reduces the opportunity cost of holding non-yielding assets like silver. Industrial demand, which paused during the conflict, comes back with months of accumulated need behind it. Investment demand returns as the macro headwinds reverse. And all of this converges on a silver market that has been in structural deficit for years, and where above-ground stockpiles have been depleted at a pace that only accelerates with every year of demand growth in clean energy and technology. That is not a small story. That is a massive story. And right now, right at this moment, while most investors are watching silver fall and assuming the worst, the conditions for an eventual reversal are quietly building beneath the surface. Drop your thoughts in the comments below. Do you think silver's setup here is as significant as the data suggests? Are you watching the Iran ceasefire negotiations and what they mean for precious metals? I want to know where you stand. The conversation in the comments on this channel is always worth reading, and your perspective matters. Here's the final insight I want to leave you with. Silver's story in 2026 is a story of two markets operating in parallel. In the paper market, the futures market, the ETFs, the speculative positions, silver has been crushed by macro forces that the war created. In the physical market, the manufacturers, the solar producers, the electronics firms, buyers came back the moment the price got cheap enough to make economic sense. These two markets cannot stay disconnected forever. History shows that physical reality eventually overwhelms paper price action. The question is not whether silver recovers, the question is when, and whether you understand what's happening before the crowd figures it out. If this analysis gave you a clearer picture of what's actually happening in silver right now, share this video with someone who needs to hear it. Not everyone is paying attention to the signals that actually matter in this market, but you are. And that's exactly what Gold and Silver Intelligence is here for. Like this video if you found the analysis valuable. Subscribe if you haven't already. We go deep on precious metals, macro trends, and geopolitical forces that move real money in ways that most channels simply don't cover. And we'll see you in the next one.